Alright guys, so if you've been watching your investment account over the past few weeks and feeling a little sick to your stomach, guys, I completely understand and today's video is for you. The stock market has been getting hit hard, oil prices are surging, and a lot of people are either panicking, pulling their money out, or just frozen not knowing what to do next. But guys, before I dive into the details of this video, in case you're new around here, my name's Nima and welcome to the channel. I'm a corporate executive with over 15 years of experience in both sales and finance. My videos break down complex financial concepts to help you on your financial journey, whether you're just starting out or if you're already a seasoned pro. So guys, let's jump into today's topic, which is how to invest in 2026 after the stock market drop. So guys, let's begin. And listen, make sure you watch this video all the way to the end because I'm going to break down some specific things that I think you should be actually putting your money into right now. And honestly, you do not want to miss it. But I'm going to dive into what's actually happening underneath the surface of all of this, market chaos, and why it's happening, and most importantly, how you should be thinking about your money and your investments going forward. Because guys, once you understand the bigger picture of what's really going on here, a lot of the fear starts to fade and the opportunity starts to come into focus. Okay, so we are living in a debt-driven global economy and the scale of it is genuinely hard to wrap your head around. Government debt alone globally has exploded from around $20 trillion just 25 years ago to over $111 trillion today. And guys, that's just the government debt. That doesn't even account mortgage debt, auto loans, credit card debt, student loans, or even money investors borrow to invest with. And I'm going to explain to you why this matters so much. On an economic model built on this much debt, you absolutely cannot have prices going down for a prolonged period of time. Think about it this way. If you have a $300,000 mortgage and your income goes from $100,000 a year down to $70,000 a year, suddenly you're in serious trouble because keeping up with those payments is going to be almost impossible. But if your income grows from $100,000 a year to $150,000 a year, that same mortgage becomes much more manageable. The debt stayed the same, but your ability to service it improved. And that's exactly how the global economic model works. It needs inflation, it needs wages going up, it needs tax collections rising, and it needs investment prices climbing, all to keep the debt from imploding. And this is not a conspiracy theory or a hunch, it's just math. And once you understand that, you understand why long-term direction of the market, despite all of the short-term chaos, is essentially predetermined. So now let's talk about what actually happened the past few weeks, because a lot of people were confused when they saw stocks, bonds, gold, and crypto all dropping at the same time. I mean, aren't bonds and gold supposed to be safe havens? Shouldn't they go up when stocks go down? Well, normally, yes, but what happened here was different. When the conflict in the Middle East broke out and oil prices surged, it triggered fear across every single asset class simultaneously, and that created what's called a liquidity crunch. And here's how that works. A lot of investors, institutions, and even countries borrow money to invest, and when the market drops fast, those borrowed positions start getting called in. Suddenly you need cash and you need it fast, sometimes within 48 hours. And in that situation, you don't want to sell what you want to sell, you sell whatever you can sell. So people were dumping their gold, selling treasury bonds, liquidating crypto, not because they wanted to, but because they had no choice. It was a sell everything to get cash environment, and that's why everything went down altogether. The important thing to understand here, guys, is that this type of selling is not a reflection of the underlying value of those assets. It's a reflection of panic and forced liquidation. And historically, once that kind of selling pressure clears, the market tends to find its footing and resume the direction it was already headed. But guys, before I dive into more of how to invest in 2026 after this stock market drop, if you're gaining any value from this video already, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. Your support helps this channel grow, so please guys, show some love by smashing that like button, commenting down below, and subscribing. Alright, now let's get into the next segment. Okay, so now let me go ahead and explain how you should actually be thinking about your money during all of this, because mindset is everything in moments like these. Guys, the single biggest mistake that people can make during a market downturn is trying to time it, pulling their money out at the bottom, hoping to jump back in at the perfect moment. That is not not the way to go. And I'll be straight with you, almost nobody gets that right in general. By the time the news feels safe enough to get back in, the market has already recovered, and a huge chunk of that drop that you missed is actually sitting on the sidelines. The people who build the real wealth through the stock market are not the ones who are in and out. They're the ones who stay in, stay consistent, and treat volatility as a feature of the game rather than a reason to quit. Think about the long-term chart of the S&P 500 over the past 30 years. Every single crash, every single crisis, every single scary headline, the market eventually pushed through it and it went higher. That's not an accident. That's the system working exactly the way it was designed to work in a debt-driven economy that needs asset prices to rise. So right now, the most important thing that you can do is resist the emotional pull to react, zoom out, and make decisions based on where things are going over the next 5 to 10 years, not based on where they are today. Now, before I tell you what I think you should be doing with your money, let me talk about what you should absolutely not be doing, because avoiding these mistakes is just as important as making the right moves. First and foremost, the most important thing, do not borrow heavily to invest right now. I know margin debt and leveraged investing can feel exciting when markets are moving, but what we just watched happen to investors who were over leveraged should be a real wake-up call. When you guys borrow money to invest, you give up control. The market drops and you get a margin call, and suddenly you're being forced to sell at the worst possible time. That's exactly how smart people end up making catastrophically bad financial decisions, not because they're dumb, but because the leverage took the decision out of their hands entirely. Secondly, do not make big concentrated bets on individual stocks right now while uncertainty is this high. Guys, this is not the environment to be a hero with your portfolio. And thirdly, do not let fear push you into holding cash indefinitely. Yes, having a cash cushion is smart, and I'll talk about that. But sitting entirely in cash while inflation is running hot is its own form of losing money too, just more slowly and quietly than a market crash. The value of your cash is being eroded every single month by inflation, and that loss is just less visible than watching a number drop on a screen. So let me get into what I really want you to understand in this video going into the second half of 2026. We are not in a permanently broken market. We are in a temporary disruption inside of a much longer trend that has not changed the direction. If the conflict in the Middle East de-escalates and the Strait of Hormuz reopens, the pressure on oil prices eases, inflation expectations come back down, and the conditions that were driving the market higher earlier this year come back into play pretty quickly. Markets are like a coiled spring right now. Investors are sitting on cash and they're waiting for a reason to get back in. And when that reason comes, things can back up faster than most people expect. And even if the conflict drags on longer than we hope, the response from the economic system is going to be the same thing as it always is. More money printing, more stimulus, more liquidity pushed into the system to prevent prolonged recession. Now, that might not be great for inflation long term, but it is historically very good for asset prices. So the question isn't really whether the market recovers, it's whether you're going to be positioned to benefit from it when it does, or whether you're going to be sitting on the sidelines watching it happen without you. So guys, here's what you came for, my actual thoughts on where to put your money right now, and I want you to think about these as a complete picture working together rather than just individual picks. First, stay invested in or keep adding to a broad S&P 500 index fund or ETF. This is your foundation. If you've been dollar cost averaging, meaning investing in a consistent amount on a regular schedule, regardless of what the market is doing, do not stop now. A down market just means that you're buying more shares at a lower price, and that is a good thing for your long-term returns. Second, add some international stock funds or ETFs to your mix. The US market has been dominant for years, but diversifying globally gives you exposure to economies that may be less impacted than what's happening in the Middle East. Thirdly, and I feel very strongly about this, get some gold into your portfolio if you don't have it already. Gold has actually outperformed the S&P 500 over a significant stretch of time, and in an environment where inflation is a real ongoing concern and governments around the world keep printing money, gold is not just a hedge, it's a serious asset. The money supply has been growing for decades with no sign of slowing down, and it simply takes more dollars over time to buy an ounce of gold, and that's not going to change anytime soon. And fourth, keep a small cash cushion cushion. Not all cash, preferably, but enough that if a real opportunity shows up or if the market drops further, you at least have the ability to move on it without being forced to sell something else. That combination of broad index funds, some international exposure, gold, and a cash reserve is, in my opinion, a really solid foundation for navigating 2026 and beyond. Guys, I want you to stay patient, stay diversified, keep investing, and let the math work in your favor over time. I really want to thank you guys for watching this video all the way through. If you gained any value from this video, please like, comment, and subscribe. I make new videos every other day, and I really look at all of your comments so that we can help get your money right. I appreciate you guys watching, and I'll see you guys in the next video.